Welcome to the deep dive. In the world of bleeding edge tech, we're always looking for the company that's truly building the future, right? Quantum Computing Inc., or QUBT, well, it's certainly grabbed headlines, boasting a market valuation that stretches into the billions. But here's the kicker. What if I told you this multi-billion-dollar company has generated a mere $263,000 in revenue over the last year? Today, we're diving deep into QUBT to unravel that paradox.
Right, and it's a fascinating paradox.
Exactly. Is this company genuinely laying the foundational picks and shovels for the quantum revolution?
Or, as some sources suggest,
Is its staggering valuation a quantum leap too far from reality? By the end of this deep dive, you'll have a clear understanding of the incredible risks and the equally incredible potential at play here. Our mission today is to extract the most important insights from a stack of comprehensive research, detailed business analyses, financial reports, market sentiment data, to give you a balanced and comprehensive perspective on this innovative yet, well, enigmatic company as of September 12, 2025.
yeah, and QEBT sits squarely at the epicenter of two explosive technological trends: quantum computing and photonic integrated circuits. Their approach attempts to navigate the long-term speculative promise of quantum against more immediate market needs. So the central question for us is whether this unique strategy can bridge that gap, or if it merely compounds the inherent risk.
Right. So to really understand QUBT's potential, we have to start with its core business. Let's open Chapter 1, Business Analysis, to see what exactly they're building and where they fit in. QUBT operates with a distinct sort of dual-pronged business model. First, they design and sell full-stack quantum machines and accessible room-temperature photonic devices.
That room temperature part is key.
It really is. It offers a much lower barrier to entry compared to some other quantum tech. Second, and perhaps even more strategically significant, they run a Photonic Chip Foundry, manufacturing high-performance thin-film lithium niobate, or TMLN, photonic chips.
Yeah, and that foundry is quite a big deal, isn't it?
It really is. This TFLN foundry isn't just a secondary revenue stream. It's a strategic hedge against the uncertain timeline of quantum computing. It allows them to target a much broader market, including crucial applications in AI, 5G, and defense.
So markets that exist now.
Exactly. The market for photonic integrated circuits, or PICs, is projected to grow to an impressive $38.4 billion by 2029. That offers a near-term path to substantial revenue that isn't solely dependent on the full commercial viability of quantum computing itself.
Okay, but where are they now in terms of revenue?
Well, currently, QUBT's revenue streams are really in their infancy. We're talking $263,000 for the trailing 12 months ending Q2 2025.
Right, that tiny number we started with.
Yeah. And this revenue comes from early-stage contracts with some impressive names, though. NASA, academic institutions, a major global automotive manufacturer, and even a top 5 U.S. bank.
So high-profile early adopters, at least.
Definitely. And their product lineup is quite diverse, too. Their flagship quantum machine is the Dirac-3. It's an entropy quantum computer specifically designed for optimization problems.
So finding the best solutions among many possibilities.
Exactly. Then there's the EMI-core system, using reservoir computing for AI and machine learning tasks, particularly effective for processing and learning from time series or sequential data.
Interesting.
They also provide specialized photonic components like the UQRNG, that's a uniform quantum random number generator, an entanglement source, and a frequency converter.
Specialist stuff.
Very. And of course, those foundry services we mentioned, offering custom TFLN chip manufacturing to third parties, that positions QCI as a crucial domestic U.S. supplier.
Okay, so what's their scale like? Are they a big operation?
Not at all, really. QEBT is undeniably an early-stage, pre-commercial company. That's reflected in its lean team of only 41 employees, heavily focused on R&D.
41 people for a multi-billion-dollar company.
Right. It's striking. They are a pioneer in commercially available room-temperature photonic quantum systems. But, their most defensible market position might actually be as the operator of the first U.S.-based TFLN foundry, the one capable of processing 150-millimeter wafers.
Okay, and what about the name? Quantum Computing Inc. Some people debate that, right?
Yeah, there's been some debate. Critics suggest it's misleading because their photonic approach differs from the more widely publicized trapped ion or superconducting QUBT technologies. But it's important to clarify, their work in quantum optics and photonics is a legitimate and recognized field of quantum technology.
Got it. So connecting this to the bigger picture, what's their core value proposition? Well, their central value proposition hinges on what's known as the swap-C advantage, size, weight, power, and cost.
FOPC, okay.
Right. Unlike many competitors that require massive cryogenically cooled systems operating near absolute zero, QCI's photonic systems work efficiently at room temperature.
That seems like a huge practical difference.
It really is. This fundamental difference could make their technology significantly more practical and affordable for real-world deployment, potentially democratizing access to powerful computation.
Okay, let's move to industry analysis, market trends, and growth potential. QUBT operates at the intersection of two rapidly expanding high-tech industries. The quantum computing market itself, well, it's on a trajectory of explosive growth. Forecasts project a compound annual growth rate of over 30%, expanding from, $1.44 billion in 2025 to over $16 billion by 2034.
Huge growth potential there.
Huge. And this growth is fueled by investment, hardware advancements, cloud-based access, all that stuff. Simultaneously, the photonic integrated circuits, or PICs, market is booming.
The other side of their strategy.
Exactly. Projected to grow from $15 billion in 2024 to $38 billion by 2029, driven by the insatiable demand from AI data centers and 5G networks.
So QCI's dual strategy aims to capitalize on both of these powerful secular growth trends.
Precisely. But given these ambitious market trends, competition must be intense. Who are QUBT's main competitors, and how do they really stack up?
Yeah, competition is indeed fierce. It falls into roughly three main groups. First, you've got the technology giants, IBM, Google, Microsoft, Amazon, through AWS. They bring immense capital and cloud platform.
They're big players.
Right. Second, hardware pure plays like IonQ, Rigetti, and D-Wave, each focused on specific quantum architectures.
Different tech approaches.
Exactly. And third, photonic specialists like Sequantum and Xanadu, who are more direct technological rivals to QBT's approach. But, when comparing QBT to its publicly traded peers, a stark anomaly emerges in its valuation.
Here we go. Valuation paradox again.
Exactly. QBT has a market cap of about $2.72 billion, with revenue, as we said, of just $1.26 million. That gives it a staggering price-sales ratio of approximately 10,460 times.
10,460. Wow.
Now, compare that to IonQ at roughly 351x.
Okay.
Rigetti at 238x. Or D-Wave at 224x.
So QBT's PS ratio is just orders of magnitude higher.
Orders of magnitude. And that highlights the central point of contention in its investment thesis. It's the elephant in the room.
Definitely. Okay, shifting to the regulatory environment and barriers to entry, what's the landscape like there?
The framework for quantum technologies is still in its early stages, largely shaped by national security considerations and, frankly, the U.S.-China tech rivalry.
Right, that plays a big role.
It does. The U.S. government has implemented strict export controls on quantum computing hardware and software. Now, these regulations create a complex environment, but for QUBT, being a domestic U.S. TFLN foundry, it could actually be a strategic tailwind.
How so?
Well, the emphasis on securing the national technology supply chain could drive government and commercial customers to prioritize U.S.-based suppliers for critical photonic components.
Okay, a buy American push, essentially.
Sort of, yeah, for strategic tech. And the barriers to entry into this industry, they're exceptionally high. We're talking extreme technical complexity, intense capital requirements, and a severe global talent shortage in quantum mechanics and related fields. It's really hard to get into this game. Definitely not something you start in your garage. So with all that context, what would you say is QUBT's most compelling competitive advantage?
Well, I'd argue their most compelling competitive advantage is that vertically integrated, U.S.-based TFLN foundry.
Back to the foundry again.
Yes, because this capability is critical. It gives them direct control over their most important component. It insulates them from geopolitical supply chain disruptions, especially important given China's dominance in TFLN. And it makes them a strategic asset for the broader U.S. tech and defense sectors.
Okay, strategic positioning.
Exactly. And while QUBT has a nascent brand and, no current economies of scale, its potential cost advantage from room temperature technology is significant. Currently, network effects and switching costs are pretty negligible in this immature industry.
Right. It's still early days. Okay, now who's actually steering this ship? Let's turn to Chapter 2. Management evaluation to understand the leadership at QUBT. The leadership team seems to be in transition. It's headed by Dr. Yuping Huang, who serves as interim CEO, chairman, and chief quantum scientist.
Wearing multiple hats. Definitely. He brings a deep technical background with a PhD in quantum physics, and he was the founder of QPhoton, the company QCI acquired back in 2022.
So the technical visionary is in charge, at least for now.
Seems like it. The broader management team is relatively new, though, with an average tenure of just 0.3 years. That indicates a significant organizational shift.
A lot of change recently.
A lot. And a serious challenge for management has been responding to securities fraud class action lawsuits, which allege misleading statements and pose a significant test of governance.
Oof, lawsuits are never good.
No. So, given this new leadership team, how are they handling the company's finances? Let's talk about their capital allocation strategy.
Right. Well, as a pre-revenue entity, QUBT's primary capital allocation goal is, unsurprisingly, internal investment for growth. Funding the TFLN foundry, accelerating commercialization, covering R&D, that's where the money goes.
Makes sense.
The $200 million private placement in June 2025 really highlights this focus. They have no share buybacks or dividends, which is typical for high-growth tech companies reinvesting all capital.
Standard procedure for this kind of company.
But crucially, the company relies heavily on external capital, leading to massive share dilution, a 448% expansion since its NASDAQ debut.
448%. That's huge dilution for existing shareholders.
It is. So management is in a high-stakes race. They must convert cash from equity sales into value-creating assets before that capital runway is exhausted.
A race against time and cash burn.
Precisely. Their return on invested capital, or ROIC, how efficiently they're generating profits from capital invested, is currently negative. That's expected for an early-stage company. But the real question is its future ROIC potential.
Right. Okay, let's unpack the numbers more directly with Chapter 3, Financial Analysis. This is where we get into the cold, hard facts of QBT's financial health. Quantum Computing, Inc. commands a market capitalization of approximately $2.72 billion.
There's that number again.
Yeah. This figure is the central, most striking aspect of its financial profile, and it stands in stark contrast to its current operational results.
Understatement of the year.
Right. Its revenue growth is basically in its infancy. 0 in 2020-2021, $136,000 in 2022, $373,000 in 2024. But the trailing 12 months ending Q2 2025 saw only $263,000.
So it actually went down recently.
It did. This recent slowdown, driven by a weak Q2 2025 with a 66.67% decline, highlights the volatility and lack of recurring revenue. It's bumpy.
Very bumpy. What about profits? Or rather, lack thereof.
Yeah, exactly. Examining their profit margins, QUBT is structurally deeply unprofitable. They report staggering negative figures, like an operating margin of negative 12,474.99%.
And a net margin of negative 29,053.99%.
Wow.
These extreme numbers result from heavy R&D and administrative costs over $26 million in 2024.
Exactly. As for free cash flow, it's consistently negative. The trailing 12 months figure is about negative $25 million. That's the cash burn.
Burning $25 million a year.
Which is critical for estimating their financial runway. Given these losses, what does their balance sheet tell us about their financial stability?
Well, this is interesting. QUBT is effectively debt-free. They have a debt-to-equity ratio of 0.01, meaning virtually no debt compared to shareholder equity.
That's prudent for a high-risk venture.
It is, and their current ratio is an extraordinary 88.17, indicating they have vastly more short-term assets than liabilities, which on the surface looks incredibly strong.
88? That sounds amazing. What's the catch?
The catch is where those assets came from. This high current ratio is almost entirely due to the $348.8 million cash infusion from recent stock offerings, not from operational profits.
So it's investor cash, not earned cash.
Precisely. So while they're well funded for the immediate future, it doesn't speak to long-term operational health, especially considering that $25 million annual cash burn rate.
Right. Runway, but it's burning fast.
As we mentioned, they also do not pay dividends. No surprise there.
None at all. Okay, let's tackle valuation analysis. The price-to-earnings PE ratio, while it isn't meaningful due to their negative earnings, can't divide by 0 or less than 0 meaningfully.
Correct.
However, the price-to-sales PS ratio for QUBT is, well, we said it before, but it bears repeating, an astronomical approximately 10,340 times.
10,340 just rolls off the tongue, doesn't it?
Doesn't it just? And let's reiterate the comparison. D-Wave trades at about 224x, Rigetti at 238x.
Right, so QUBT is vastly, vastly more expensive on that metric.
Which clearly underscores the extreme market optimism embedded in QUBT's price.
Or perhaps speculation.
Perhaps. Given how speculative this valuation is, how do we even begin to think about its intrinsic value? is if DCF even possible.
Look, intrinsic valuation, typically done with a discounted cash flow or DCF model, is usually about projecting future cash flows. But for QUBT, performing a DCF is a highly speculative educational exercise.
Educational exercise. Meaning, don't bet the farm on it.
Exactly. It relies on, frankly, heroic assumptions due to the lack of history. But with that huge caveat, an illustrative DCF model yields a potential value range of $2 to $25 per share.
$2 to $25, that's an incredibly wide range.
It is, and it highlights the binary nature of the investment. It could go near zero if it fails, but there's potentially substantial upside if it succeeds grandly.
What kind of assumptions get you to that range?
Well, the key DCF assumptions involve hiker growth rates for years. For example, a 383% jump in revenue to almost $3 million in 2026.
Starting from a low base, but still huge growth.
Right, and a very high discount rate, 20% or higher, to reflect the exceptional risk involved.
Okay, highly speculative indeed. Let's turn now to Chapter 4. Market sentiment. What's the broader market's view on QUBT? Are analysts buying this story?
Well, analyst coverage for QUBT is sparse, which is common for a company at this stage.
Not many covering it yet. No. The consensus rating among the few analysts who do is buy or hold. The average 12-month price target is approximately $18.50. With the stock currently at $17.01, that suggests limited near-term upside according to those analysts.
Basically saying it's fairly valued now, maybe slightly undervalued.
Kind of. News around QUBT is mixed. There's positive operational progress, like new orders from that major bank and automotive manufacturer we mentioned. But then there was a negative Q2 2025 earnings miss.
So good news on deals, bad news on recent financials.
Pretty much. And the media tone often highlights its meme stock characteristics, mainly due to that massive valuation disconnect we keep coming back to.
It's hard to ignore. What about short interest? Are professional investors betting against this company? The short interest is incredibly high, standing at 19.45% of the float, and some sources even put it up to 21.2%.
Wow, nearly a fifth of the available shares are shorted.
Exactly, which means a large and presumably sophisticated segment of the market is actively betting against the stock. This transforms QUBT into a classic battleground stock.
Bulls versus bears.
Precisely. Long-term bulls versus bearish short sellers.
What?
And this creates a highly volatile trading environment for you, the listener. Positive news could trigger a short squeeze, sending the price flying. Or negative news could lead to a rapid price decline as shorts pile on. Prepare for fireworks.
Good point. High volatility is almost guaranteed. Okay, looking at market indicators, moving averages, what do they tell us? QUBT's price of $17.71 is currently slightly below its 50-day simple moving average of $16.70.
Uh-oh, short-term bearish signal.
Generally considered a bearish short-term signal, yes, suggesting it's lost recent upward momentum. However, the price is significantly above its 200-day simple moving average of $11.68.
Okay, so the longer-term trend is still up.
That's the takeaway. It indicates a strong overall uptrend despite the recent weakness. A mixed technical picture. Now let's explore Chapter 5, ownership structure. Who holds the reins, or at least the shares, at QUBT? How much do institutions own? Institutional ownership stands at a moderate 38.67%. Not super high, not super low.
Okay, what kind of institutions?
We see two main types. First, passive index funds like Vanguard and BlackRock. Their holdings are largely due to QUBT's inclusion in indexes like the Russell 2000, 3000. They have to own it.
Index inclusion driving demand.
Right. Then there are active hedge funds and trading firms, names like Jane Street, Anson, and Citadel.
A faster money.
Likely attracted by the stock's volatility and trading opportunities.
Makes sense. What about the people closest to the company, the insiders? What are they doing with their shares? Okay, this is quite interesting. Dr. Yuping Huang, the interim CEO, owns a substantial 13.31% of the company.
13%. That's significant skin in the game.
It certainly is. However, there's a concerning pattern of consistent and significant insider selling over the past 12 months.
Selling by multiple insiders.
Yes. Multiple executives, including Dr. Huang himself and Director Javad Shabani, have sold shares.
That doesn't usually look good.
Well, look, insiders sell for many reasons. Diversification, taxes, buying a house, whatever. But a persistent pattern across multiple executives, well, it can be interpreted as a bearish signal. It potentially suggests those with the most intimate knowledge believe the stock may be fully or even overvalued at current levels.
Something to definitely keep an eye on. What about overall ownership concentration? It's fairly concentrated, with Dr. Huang holding over 13% and the top institutional holders also having significant stakes. Their actions can disproportionately impact the stock price and liquidity. Fewer big players means bigger waves.
Good point. Their decisions matter a lot.
Okay, we've covered a lot of ground. Now we arrive at the crucial Chapter 6, risk assessment. This is where we synthesize the strengths, weaknesses, opportunities, and threats, the SWOT analysis. Let's start with the strengths. What does QUBT have going for it?
Well, unique room temperature photonic technology, that's one. Operating the first U.S.-based 150mm TFLN foundry, a unique strategic asset.
The founder again? Yep. Also a strong balance sheet. $349 million in cash, virtually debt-free. Deep technical expertise, especially through Dr. Huang, and that vertical integration from the foundry.
Okay, a solid list of potential advantages, but what about the operational reality? Let's talk weaknesses. Well, the most glaring weakness is the company's near-zero revenue and consistent, significant losses. That's unavoidable.
The core financial problem.
Right. There's also that extreme shareholder dilution from constant equity financing. Unproven scalability, can they actually ramp up production and sales? And management is navigating recent transitions, and those securities fraud lawsuits we mentioned, those are real drags.
Okay, significant hurdles. Moving on to opportunities. Where's the potential upside? Massive addressable markets, both in quantum computing and PICs. That's huge.
Two big ways to ride.
Exactly. Geopolitical tailwinds that U.S. government focus on onshore supply chains helps their foundry, a potential first-mover advantage with the U.S. TFLN foundry. And an interesting angle, their low-power photonic chips could be pitched as a solution for the burgeoning AI energy crisis.
The power consumption issue with data centers? Clever angle.
Could be. But now, the threats. What are the biggest risks looming over QUBT?
If we connect this to the bigger picture, the most pressing threat is simply the extreme valuation risk, the 10,000 times price-to-sales ratio.
The number we can't escape.
Exactly. It makes them highly vulnerable to any negative news or market shifts. A slight miss could cause a big drop. There's also intense competition from tech giants and other well-funded quantum startups. The constant risk of technological obsolescence. What if a better quantum tech emerges? And, of course, adverse macroeconomic factors that could dampen investment in speculative technologies like this.
Yeah, a recession wouldn't be kind to a pre-revenue tech stock. Speaking of macro, let's quickly touch on the impact of macroeconomic and geopolitical factors. You mentioned macro. Higher interest rates definitely hurt speculative long-duration assets like QUBT.
Right. Higher discount rates, more expensive capital, basic finance.
Yep. And geopolitically, that U.S.-China tech rivalry we discussed, it's a double-edged sword. Export controls create complexity for everyone in the field. But the U.S. strategic imperative for domestic supply chains for critical tech semiconductors, quantum, that directly benefits QCI's U.S.-based foundry.
So geopolitics is both a risk and potentially a benefit for them specifically.
Seems that way. Okay, we've reached the final stage of our deep dive. Let's pull everything together in Chapter 7, Conclusion. Let's synthesize the findings, starting with the bull case for QUBT. What's the optimistic view? Bulls would highlight a de-risked dual-pronged strategy. The TFLN foundry provides tangible, nearer-term revenue potential, hedging the quantum uncertainty.
The foundry is a safety net.
Kind of. They'd also emphasize QUBT as a strategic national asset due to that U.S.-based foundry, benefiting from geopolitical focus on supply chain security. They'd point to the differentiated technological edge. Room temperature, low-power photonic tech offering a practical, cost-effective path.
The swap-C advantage.
Exactly. And finally, a strong financial position, that robust cash balance of nearly $350 million, virtually no debt, giving them a multi-year runway to execute.
Okay, that's the bull story. But what about the bear case? What are the compelling counter-arguments? Well, the bearish case is equally, if not more, compelling for many. It centers fundamentally on that valuation disconnect, a multi-billion-dollar market cap utterly unsupported by minimal revenue.
The core paradox.
Right. There's a lack of proven execution history, substantial ongoing losses, and growing cash burn. Intense competition isn't going away, and that inevitable dilution continues to erode shareholder value over time.
And you mentioned red flags earlier.
Yeah, what's fascinating here are those red flag indicators.
Yeah.
The extremely high short interest and the pattern of consistent insider selling. These signal significant skepticism from sophisticated market players and potentially from company executives themselves regarding the current valuation.
Okay, strong arguments on both sides. So let's get to the valuation summary and concluding outlook. So what does this all mean for you, the listener? The intrinsic value analysis, highly speculative as it was, produced that exceptionally wide potential range, $2 to $25 per share.
A huge range reflecting huge uncertainty.
Exactly. The current share price of $17.01 falls smack in the middle of this range. However, justifying that $17 price, let alone the higher end, means QUBT needs near-flawless execution and massive market capture in both photonics and quantum.
Which is far from guaranteed.
Far from it. The lower end of that range, $2, reflects the very real risks of failure or significant delays. Ultimately, an investment in QBT today is a high-risk, high-reward bet. You're betting on a compelling story, a unique strategy, and a deeply technical team.
A story stock, essentially.
Very much so. It's suitable only for investors with a very long time horizon, a very high tolerance for extreme volatility, and frankly, the capacity to withstand a potential total loss of capital if things don't pan out.
Definitely not for the faint of heart. As we wrap up, maybe consider this. In this race to build the future of computing, is it more valuable to be the one building the foundation, the picks and shovels like the foundry, or the one promising the ultimate quantum leap with the computers themselves? QEBT's unique strategy attempts to be both, but only time will tell if that ambition leads to unparalleled success or a steep fall.
A great final thought, and thank you for joining us on this deep dive into Quantum Computing, Inc. If you found this insightful, please remember to like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. Members get priority deep dives on tickers like this one. For just $4.99 a month, you get exclusive priority access. And we're covering all of the S&P 500 stocks over the next few months, so members will get those first.
That's a lot of companies.
It is. And if you want a one-off deep dive on a specific stock that interests you, just drop us a super thanks on YouTube. We love hearing what you want us to unpack next. And just a quick reminder, this analysis was generated by an AI system. It's intended for educational purposes only and should definitely not be considered financial advice.
Please do your own research.
Absolutely. Conduct your own research or consult with a qualified financial advisor before making any investment decisions. Until next time, keep digging deeper.